Hello, folks. Welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone, as usual, and want to just start off some disclosure slides. Now, we do these webinars on Mondays. It's going to be back after our break for Labor Day, and we do this on Monday at 2, and then we also do market trends on Thursday afternoon. Today we look at the big indexes, mostly with the weekly time frames to kind of have a sense of what the state of the market is now. And then we have on Thursdays, we look at individual stocks, we look at some of the actual more news-driven events or things that are happening. So I'm just showing some disclosures now. Great to be with everyone. I'm going to share um, some disclosures as well in the chat. And I'm going to show you also our standardized returns of some of the ETFs we look at. We look at some of these ETFs. So this is a TradeStation platform. I use TradeStation for this, and I use TradingView for some of the weekly charts as well. So um, as we look now, I think what's really interesting here is that essentially um, we're seeing a lot of attempts to give a narrative where there's really just seasonality and volatility. And so the last time we were on, well, I mean, the main thing right now is that basically, since the beginning of August, people have been trying to look at volatility in the market and describe it as some kind of fundamental thing about the stock market or the economy, when in reality, it's volatility and seasonality. They've talked about things like recessions and things like that, but none of that stuff has panned out. The economic data has not really confirmed it in any way. When you look at things like retail sales, initial jobless claims, you can look at some of the PMI data and things that were softer, but none of the data really confirms that. And I think it's important. It confirms the idea of there being a recession. I think it's important to realize that in the world of news and analysis, something crazy happens, and one guy says, "Well, it's just volatility." The other guy says it's a recession, and then the guy who says it's a recession is the guy who the news media will quote because they're looking for more of a narrative. When in reality, the market simply has volatility. We have to recognize that. So these are the main ETFs. And I'm just going to start off now by mentioning that go over to TradingView, look at our weekly charts, start here looking at the Dow. But about 2 weeks ago, we were basically talking about rotation away from the mega caps into other areas, like at that time it was things like consumer staples, real estate, and stuff like that, and it has played out kind of as we expected. One thing I think is interesting though is that I actually, we had some real interesting breadth things that were happening in terms of stocks hitting new highs, advanced decline line. And I honestly have to say that I believe that breadth is almost becoming a contrary indicator in the market right now. It seems to actually be most bullish right before the market's going to pull back. And there's a reason, because we are now hyper focused on mega caps. So what tends to happen is at a period when the market is slowing down and the leadership is stalling, what happens is money goes into all those other stocks like consumer staples and things like that. They outperform. It looks like it's good breadth, when in reality, what's happening is the leadership is breaking down and then we get a pullback. So I think it's actually important to realize that we have a strange dynamic now, and I'm starting to actually believe that breadth is losing its importance as an indicator. It's almost becoming contrary. But I will say something that's interesting. If you go back to, I'm going to go back here, like to look at to early 2022. At that moment in time, you can see financials actually were holding up better in the earlier stages of the bear market that happened. Things like materials were going to new highs, or at least trying. Things like industrials are doing well. At the same time when technology was really breaking down at that time in early 2022. So what's interesting is that we essentially see that we have had a rotation toward these non-tech things in early 2022, because at that time people were worried about the Fed hiking rates. But now we basically have people worried about or expecting the Fed to be cutting rates. So I think we have to realize we're in a situation here now where the qualitative nature of this pullback is much less really, I think, meaningful or bearish as it was on a fundamental level. I think we have to take a step back and just kind of recognize that we are at a spot where the ECB is going to be cutting rates soon, judging by all indications that are broadly expected. The Fed We had earnings that were 200 basis points above expectations last earnings season. We're entering a period of double-digit earnings growth. Those things are all out there. I did not yet look at anything happening with Apple, but they have their iPhone thing that is going to be coming out soon. You have a lot of different things that are out there that are it's hard to see many of them as being actually negative. So I think that there's these moments that come up when people try to predict the end of the world or just say things like recession, but when you really take a step back and look at any of the indications, none of them really turn into that. Even if you look last week, if you look at the CME Fed Watch tool, it's kind of interesting here, but if you look at CME's Fed Watch tool, you can actually see that nothing really changed in terms of expectations of interest rate cuts. Um, this will come up here, but the expectations last week, amid the market pulling back and stuff, it really barely changed in a period of 1 week. We were more or less sitting at 25 basis points is what people expect. So that's the main thing I really want to mention. And I do think it's also interesting that when you look at the market overall here, is that things like Bitcoin and silver are not following through to the downside, and that's just interesting to me, not because they're necessarily assets that have any immediate sort of interest to me, but it's more the fact that things are not following through to the downside. We get these big drops and there's no follow through, and now I think we're setting up in a spot where we have some potential patterns of pullbacks having occurred, and basically no continuation to the downside, and that might actually turn into something that's a little bit tighter than people want to see if you're really bearish. So this situation right now, the worst month of the year, the market pulled back, but it's kind of stabilizing, and it's stabilizing at some interesting levels that we're going to get to looking at the S&P 500. I also want to mention right off the bat that right now communications and consumer discretionaries, we're going to look at XLC, XLY. Those are in some spots right now where they're very tight, and people who want to come back to those mega caps might be looking for some interesting activity in those, with the potential for those to kind of, squeeze toward potential breakouts. We have, some space, some time on the weekly charts for that to happen, but we're going to get to those. So anyway, overall, right now, my view is that there's not a huge edge in any individual sector. It's more of the broader market. So look at the actually started the S. What do we start with? The S&P. Sorry, my list here got kind of jumbled. All right, so we look at the S&P. We were talking about around 5560, and we were noticing the level 5560 on the S&P 500. We had talked about how it was kind of an important level here. I'm gonna look at the daily chart as well here really quickly. 5560 here was like this. It was like this daily level up here that we held for 2 weeks in a row. We broke under it, and then sure enough, we got continuation to the downside. But now what's interesting is I think we have some really important sort of areas here. So if you look on a weekly chart, this is basically, if you kind of go from where we opened on that big ugly, Monday, August 5th to here, that's a 50%. We held a 50% retracement last week. If you make it a little bit bigger and take it down to the low of that week, then we're also above a 50% retracement. So held basically more than half the rebound. That is a potential sign that there is more strength in this than not. Also, 5,400 was an important level. You can see on the weekly chart, it was a support. It was a weekly low 2 weeks in a row. On the daily chart, this was an important one. This was a dovish CPI report on June 12th. So basically, that was a light CPI report, and you can see that basically the market gapped higher. And basically, if you look here in late July, as we started to pull back, it was an important level we held on July 25th, and then the following week on Tuesday, July 30th. So this was like an important level, and then we knifed below it, and we got that continuation. But the thing is, 5402, 5400 was an important level on these daily levels, on the weekly. And so you basically have here, a bunch of different things happening. Also, 5390 was a level that also had, where was it? There was a level here on 5390. It was basically, it was kind of this low right around here. So kind of between 5390 up to kind of 5446, because there was this other level here that was this low in late June, 5446. But when you look at these kind of lines here, this space has a lot of relevance on the daily and on the weekly time frames. And the key thing is we went jamming down. We hit that 5,400 and we immediately bounced at it. Now, to me, this is interesting because this is not exactly what you would call a kicker candlestick. A kicker is when you plunge and you go gapping up above the top. But what's interesting is we plunged and then we come right back and we basically, left it down there. It's kind of like abandoned, like people selling down there are just kind of that's abandoned now. And so, I think right here, we're in a situation where 54.46, this level going back to June 25th. You see, we had this was the rally on the CPI, continued higher back here, June 25th. You can see now that is potentially stepping in as a support level. So we have, held that 5,400, held the 50% retracement. Now, trying to hold that higher level. So then you look at put all these pieces together here, and this is something that it's not giving the bears what they want to see, and it's kind of suggesting here that there is some support overall in this market. And I think we have to look at it, really, like I mentioned, realize the Fed is going to be cutting, the ECB is going to be cutting. I mean, expected. I mean, I should say it's going to be, but broadly expected. Now, you do have the flip side of that. There is this nightmare scenario that by the Japanese central bank raising rates when the Americans and the Europeans are cutting, that you could create another nightmare scenario of the yen rallying. And I guess that is a possibility. And maybe that's something that people have to kind of bear in mind and watch for a potential risk of euro yen tanking, dollar yen, Aussie yen. Looking at pairs like that can be something, just keeping an eye on them. There's different ways to watch currencies. You can actually, they're on TradeStation as well. These pairs, we don't support futures. We don't support the spot trading of currencies, but you do have, AUD, JPY, Euro, JPY. You can track those on TradeStation as well. You can set alerts and things like that. So from my view, this is something that's one of those risks that's kind of lingering out there, but at the same time, it's one of those nightmare scenarios that might just turn into just this sort of boogeyman that's out there that never really, comes true. I mean, the question are the Japanese interested in trashing the global financial system? Probably not. So, they did they said, we know we're going to be hiking rates, but at the same time, they came out and said they weren't interested in creating chaos. So that's a risk I want to mention that's out there, but at the same time, we shouldn't make too much of it. It's one of those things just to kind of keep your eye on and be aware of. But overall here, I think the key thing in the S&P is 5,400 kind of area held, and now back to this level. These were weekly lows from this point in late June, early July. And, at this point, I think we got to kind of bear that in mind. People expected weakness in September. We got it. And now the question is, are we going to get much more? CPI is coming out soon. We have the Apple event that was an hour ago. And then we have the Fed expected to cut rates next week. Then after that, we get to earnings season, which, we're entering double digit earnings growth at this moment in time. All those things are kind of out there. So I think, that's kind of the main sort of backdrop we have now. Now, if you look at the Qs, if you look 2 weeks ago when we did our last webinar, we had mentioned this level, this high from March, and boom, look where we sat and we held. So now I think it's interesting to see that we've basically held that sort of level. And, I think it's interesting that on the daily chart, you also see a very similar kind of candlestick of just this slam down without the continuation lower. And this is an inside day we're now forming on the daily. So again, it's like this is actually a bearish continuation pattern if you view it as an inside day. But at the same time, if we do kind of remain above that level, there is the possibility of that simply becoming a kind of abandoned lower price that doesn't get revisited, and then basically it can sit and hold. So what I'm kind of watching for here, and I think when you look at the seasonality, and there's a negativity about some of the things like in big tech and stuff. And what I can see now is that it's more that the short-term momentum continues to be with things like the financials and the industrials that we're going to get to. But at the same time, the question is if the tech names can kind of hold here and not manage and not break down further, then we can be setting up for a spot where in a few weeks there could be a rotation back to them, which will overall be a net positive for the market. And we could be in a period here of the kind of value, cyclicals, non-tech performing better in the near term, but then also laying the foundation for a potential, reversal to the upside in growth in a few weeks. And I think that's kind of the playbook here that I think we want to look at. You look at a chart like this, it has to kind of pay its dues and do and kind of hang in there. However, it has had a significant pullback. It is holding a potential support level. It's turning an old high into a new low. And remember, back here in June, it turned resistance into support briefly, but now it has a chance to do it again. So I think sometimes, charts just they have to do things over time. And if you look kind of on the longer term period here, this is a deep kind of, monthly low. This is a higher monthly low. It's turning resistance into support, the old, resistance into new support. And you can see here, same thing. That was a high, it becomes a low. This is a high, becomes a low. So right here, kind of on the weekly, this has, no short-term bullishness, but it has the beginnings of short-term stability. And I think let's see if the stability turns into something more positive over time. The Dow, on the other hand, is basically more in a short term bullishness where it's clearly holding above this high from May, making this higher low. And so overall, we've kind of mentioned how things like the Dow, the value, the financials, the cyclicals, but it's not just cyclicals, it's consumer staples, it's utilities, it's kind of everything but the mega caps that have been doing well here. And I think it's interesting just to kind of see, the if you look here, I actually should have drawn this line, this low from this week back here in mid-August. You can see that we are holding that. So I think at this moment in time, we have a similar sort of thing here where this is showing more strength on the short term time frame, and the higher lows on the weekly here are consistent with what we've been saying before. And at this moment in time, it still seems to kind of have that trajectory in place. Also, if you look at this one, a 50% retracement of the August move, this didn't even get close to a 50% retracement. So I think at this time, well, actually, if you draw it from the open that day, it actually goes exactly to a 50% retracement. And I'll say that this is, to me, is a tricky retracement. I normally like retracements going Friday to Friday, or at least you start on the end of one week and go to the next. But in many cases, this was such a strange sort of volatile move that I'm not really sure exactly where to put those levels. So I want to just mention that. But overall, when you look at it, I think that we do have a spot here where, again, this is held, and, provided there's not any more downside from here, it can be in a spot when over time the people who want that deeper pullback, they're waiting, they don't get it, and then they start kind of, sneaking in, and before you know it, there's no, it just kind of continues higher. And my expectation overall, not my expectation, but when I look at the environment right now of people looking for things to get worse when they're not getting worse, all the cash on the sidelines, the things happening with the Fed, the surprising earnings, the recession that isn't happening, all those things to me are more consistent with a process of money entering the market and the process of a secular bull market that is the fourth or fifth inning, but at the same time, or maybe it's entering the sixth or seventh inning when it is the more accelerated phase. Like if you look at a secular bull market like 1983 to 2000, in many ways, the real strong part of that started in 95, 96, when it had already been going for a while. Well, if you go from 1983 to 1995, that was about 12 years. If you go from this market kind of breaking out to new highs at the beginning of the Obama administration, that was about 12 years ago. So, these similarities from a secular perspective are actually kind of relevant. And at that spot when, the sellers are simply not there, there's not that huge selling pressure. So I think that's just one thing I wanted to mention here. Let me just kind of continue now. That was it. All right. So we have the Russell, and this is also now it's holding where it's low from last week, which is just kind of interesting. I don't really know what to make of the Russell. And this is something where it does these kind of weird things, but I don't like things like this. And I think more and more they become just difficult, and they really just become like weird speculative squeezes and stuff. And so the Russell at this moment in time, it's too weird for me because it's biotech and regional banks, which is it's too strange of a mix of companies. However, it's kind of holding this level, and it's interesting. Let's actually do a retracement on this one and see how well this one does. This looks like it retraced more than 50%. So this is to me, this is also not as kind of favorable of an overall setup. If my overall view of this is that there is risk in a kind of bearish market here, if things don't go well, that you actually can have this happen in the Russell and turn into a falling sort of trend here. It was, to me, the when I look at this is something that it doesn't have as much of a kind of clarity. It's way below its old highs. And when you have something like this, this is a sort of thing that might just languish here for a long time. And people might not really want to be, pushing into it aggressively until it's a more clear breakout. So when things are range bound, it can be tricky seeing them kind of continue. That was the Russell. Now, the 10-year Treasury, we had kind of talked about a lot. We had said that it was like basically had cement shoes and was going to, was just a heavy pressure with everything happening, and all that has panned out more or less as we had kind of been viewing. It's a situation now. There's more news every day about deflation in China, weakness in China, and ultimately China is a huge consumer of products and producer of products, and deflationary pressures there become deflationary globally. And I think we're entering a situation here where it really is a potentially exceedingly positive situation where China exports deflation. They don't, drive up the cost of a lot of energy and commodities. At the same time, the global oil production is increasing. I think that's actually the backdrop we have to bear in mind here. We've kind of said that, a slow grind down toward 3.25 is something people might be looking for in the 10-year yield. And overall, everything kind of plays into that. And at this point in time, you have to realize this was a lower, major lower high versus where it was back in October of 2023 here. So from my view, this was a kind of crazy rally that now you have that major lower high and you have this level here. So this is something now that suggests with people seeing what's happening with with interest rates and everything else. The 10-year here also is potentially has this space to the downside people will be looking at now. XLB materials. Now, the problem to me with materials is that you do have the China situation, which is basically that the demand for different kinds of materials and stuff is something of an issue. And most material companies are no longer just raw materials; they're things like packaging and chemicals that have American exposure. But I think right now we got to kind of just watch and see. We have some support across here, but also we had a false breakout in this. So this is to me one here that I'm going to kind of just keep my eye on. But I don't like the way that it basically had that false breakout. If you're looking at something from a bullish perspective, and I think this is one people might want to kind of, if we get a sense really of a greater kind of cyclical euphoria coming back to the market, and there is a potential for that. The problem with something like this is that this year it has not been a particularly strong performer. It might take deeper into the rate cutting cycle before this one really starts to move. But I think it's important to realize we have a long-term breakout here. It's just that in the near term it might need more time to go. If you look from 90 to 94, that is not a very big overall move when you consider the potential this might have for like a real extension to the upside. Then when you look at the amount of time this has been moving sideways, people might actually say, this thing could move a lot to the upside if it does actually break out. But the thing is, it's not there yet. So I think this is one people might want to keep on their list, that it's still kind of stuck back here at where it was at the beginning of 2022, and just kind of think when this does break out, and when people want to be focused on materials, then this is something that could actually have a sustained move, but we're not necessarily there yet. Now, communications are interesting to me because we have this kind of double top at 88. But what's interesting is look how we kind of held this level here. And, this is very tight here. And I think when you look at communications and consumer discretionaries within the big tech have traded better than tech itself in terms of the mega caps. You have communications, consumer discretionaries, and then you have the tech sector itself. So this here, I'm kind of watching to see between 84 and 88, see if we can kind of hold and potentially get a breakout in this. I think that's something people might want to kind of watch to see if we get a close above, this kind of weekly level. Isn't it interesting how we never closed above that July weekly? We didn't get the new closing high. You got that weekly closing high back here in June 24th week, but then after that, then it had that follow through, but we didn't get that there, and we got a false breakout and then the rejection. But let's see what happens here. Again, this is what I mean about big tech here. Could kind of go like it might need a few weeks during which people stay in financials and stuff like that. So the thing here is, let's see what happens if this can kind of hold and grind up. But the signal in this could also above that previous high of the previous closing high of 87.76. People might be kind of watching that level. And then, until then, though, kind of just a period of, optimistic neutrality. Energy is an area that we have kind of said had, it seemed to have the most downside risk, and that has been the case. At this time, it's interesting to see this level right under 88, 87 and a half. Basically, that now might be something people view as an upside sort of resistance level. Does support become resistance? That I think is what we need to have in play here. And I think overall, look at the environment of OPEC plus increasing production. We've done some stories on Market Insights about energy and the situation happening and the carnage in gasoline. There is some stuff happening right now with storms, some uncertainty in Libya, but the overall trajectory in this with the weakness in China and the increase from OPEC plus kind of keep us people looking here potentially for more downside. XLB, why would a breakout when China is slowing? Well, like I'm saying, there can be a period of time when that deflationary thing plays out in China. They stimulate their economy. Maybe something happens. Maybe after the election, the American politicians stop beating up on China and talking tough on China, and then things go back to maybe not back to normal, but they improve. That's the thing I'm saying about XLB. I think we have to watch it. There is a period, the overall sideways movement in this is something that could set up for a sustained move to the upside when it happens, but that could be months away. I just want to mention it because it is something that the longer something consolidates, it often can give a bigger move higher. All right, so financials here are basically we had a bearish outside week, but we're holding the low from the previous week. Financials and industrials in some ways have the strongest sort of weekly patterns right now in some ways. And I think basically holding this low, everything remains intact for essentially the upward trajectory here to appear like it remains intact. I think we have to realize it's a single down week. Look at this; it puts together what 4 or 5 positive weeks, one red week, 4 or 5 positive weeks, one red week, and then potential here. I've said all along that financials, from a fundamental perspective, we're in a spot where they can kind of turn up what they, their business, and this is something that looks like it's still in shape here. So for me, financials here holding this weekly level is something people might kind of view as being a positive. We had that bearish outside week. In my opinion, overall, one candle is not something we can actually interpret. I have not found outside weeks to be meaningful. I just marked it there so I wouldn't forget about it. All right, industrials also kind of interesting here to see that back here we talked about 126 down to 120 was the range. Look at now how we hold that 126. So again, resistance, new support. This is also something here I think is pretty interesting. We're seeing a lot of strength in things like airlines, which are industrials. So it's just, I think, interesting here to kind of view. Industrials have been in a quiet sort of bull market for a while here, and here we are finding support at old resistance. So that's why I said industrials and financials seem to have the most near-term sort of thing. All right, XLK, I'd kind of looked at this 205 level, and we basically went down and hit it. Now we're holding it. But I think we look here at things happening with the tech stocks, and this is just now a period of sitting and waiting until we have some interest in it. It might require the beginning of October, a new quarter, for people to kind of come back into these. That's why I'm saying for the large caps for now, we are kind of in a period of seeing if the bearishness turns into neutrality as the bullishness remains in things like financials, industrials, healthcare, and stuff like that. So right here, I think just trying to hold 205 is really the key thing that this one needs to do. Now, XLP is interesting. These are consumers who we have been talking about what was happening here, and we have pretty much this clear breakout. Look how this one closed at that high, chopped, and continued new highs on all these. And I think right here, it's something like consumer staples. At this moment, it's one of these that I don't know what opportunities people might see at the sector level. Individual names may still continue to present opportunities, but this has been, a confirmed breakout here for a few weeks, as we've discussed. Even the market pulling back, it remained green last week. Real estate also, in my view, here has been one that has this potential continuation up toward the highs from August of 2022. We had talked a lot about this, these consistently higher weekly lows. I think every single week is like a higher low going back to like, back here at the beginning of the second half. Look at this. Since the beginning of the second half, we've had every single week is at a higher low. So we've been talking about real estate investment trust for a while, and this is here one that has that trajectory in place, and people might be looking up toward this level here from 2 years ago. That's real estate. Oh, I got to go soon. I'm sorry. Utilities, similar sort of trajectory here at this point, except this is kind of closer to these highs. So up towards 78, this high from the summer of 2022. People might be kind of looking for this. Is what I'm saying. Near term, these are the things that kind of have that sort of momentum, and that's why I'm kind of saying during the month of September, it could simply be a kind of continued sort of people jumping in and out of some of these non-tech areas with then the potential in a few weeks, if tech does stabilize, you can just see it. There's maybe something about Blackwell or some upgrade or something happens with the iPhone launching or whatever it is. And then suddenly, the rotation could come back to tech. But you don't want to predict something like that. You just want to say that this is something that's out there as a potential, and then also realize that we're not there yet. But just to realize that, this market from an overall tech secular perspective, there is the potential for people to come back to these large names like Nvidia, Apple, Microsoft, and stuff like that. And I'm going to get to the more interesting one. Let me first do healthcare XLV. This is one now that is holding last week's low. Has that kind of positive sort of trajectory. Also bearish outside week. Again, the outside week doesn't matter that much to me. But holding making that recent higher low, healthcare has this sort of positive momentum as well. We've been talking about this one for some time going back here. We've noticed these higher lows. But now XLY, I think, is really in some ways interesting because we have a really tight action here. When you look at this level between like kind of 182, we've been worried about this kind of 180 level, and we got right above it, and we're kind of holding here. There's this idea. I don't think Tesla has confirmed this, but Reuters, Bloomberg has reported that Tesla's going to be doing a robo-taxi event. When is it? It's going to be allegedly sometime in October. I think they might have actually announced it. October 10th is what Bloomberg has said. But anyway, the thing here is that the economy allegedly in recession, but it hasn't been. Consumer staple discretionary stocks like Tapestry, TPR have been strong. Then you have also home builders. We did an idea today on Lennar. Home builders have been strong. You have the non-recession, those sort of things right now. We have consumer sentiment and consumer confidence, doing better than expected. So I think right now, in looking at the consumer discretionary, there's a lot of things here that are not going wrong that people think should be going wrong. The wall of worry may be in effect here. So it's interesting to me to see this kind of tight leveled out last week's outside day. If you look here at this outside week, and then we look here in XLY on the daily, it tried to rally and got jammed lower, but basically look at how it held this level. So from my perspective here, if this thing gets much above 188, it might start to ring some alarm bells for people. It's in this tight sideways movement, and I think right here, this is one where people might want to say, anything above the, if it starts to escape from this range, it might start to, grab some attention. So this is one I have kind of on my list as being interesting here. But anyway, those are the main things I want to just mention right now. Like I said, there are, when you really take a step back and look at this situation, there isn't really this recession thing is more of an invented narrative of people who want to explain the market pulling back. But there's seasonality, there's volatility, there's normal things like that happen. I think we've been up for 8 of the last 9 months or something. So we have here a period of consolidation. But I think we really do have to remember that when you look at the issues that were out there in terms of things like earnings growth, inflation, recession, economic growth, none of those things have broken in a bad direction. If anything, all the things are turning in a good direction. And I think that is the reality that we're in. And we're simply now in a period of seasonal weakness. And let's see if it can carry much further to the downside. But right now, we are getting some signs of stability taking hold. Near term, there's a lot of kind of wood to chop to see, do we get back above the 50-day moving average in the S&P and things like that. But at this point, it seems to be kind of giving us a sense of there is some stability here within a period of weakness and a period of a few weeks of probable kind of people testing it and seeing if it can hold. But those are the main things I have. And be back on Thursday with market trends. Great to be with everyone, and I'll see you later this week.